The gold price is smashing records. It's all over the news, hitting numbers we've never seen before. And the story you're probably hearing is that it's all about inflation and the Federal Reserve getting ready to cut interest rates. And that's true, but it's only a tiny piece of the puzzle. The real story, the one that matters most, is a quiet financial revolution that's happening right now, behind the scenes. It's a historic shift that could change the way the world thinks about money, and it hasn't happened in our lifetimes. From Wall Street to your wallet, this is Smart Money Sense. Today, we are diving deep into one of the biggest financial stories of 2025, the unprecedented surge in the price of gold. Over the next few minutes, we're going to break down the three powerful, interconnected forces driving this rally. We'll look at the obvious catalyst everyone is talking about, the fuel that's fanning the flames, and finally, the hidden earthquake shaking the very foundations of global finance. By the end of this video, you will understand not just what is happening with the gold price today, but more importantly, why it's happening, and what the theoretical consequences are for the economy, for companies, and for you. This is the clarity you need to make sense of the noise. Let's get into it. Alright, let's start with the driver that's getting all the headlines, the US Federal Reserve. For months now, the market has been buzzing with one big question. When will the Fed cut interest rates? As of September 2025, that question seems to have an answer. Based on market data, there's now a more than 90% chance that the Fed will announce a rate cut at its next meeting. This isn't just speculation. It's a reaction to clear signals that the US economy is slowing down. We've seen reports showing fewer job openings, and key indicators like the ISM Manufacturing Index have fallen into contraction territory. When the economy cools, the Fed's typical response is to cut rates to make borrowing cheaper and encourage spending and investment. So, how does this connect to the gold price? It comes down to a core concept in finance: opportunity cost. Think of it this way: gold is an asset that doesn't pay you anything to hold it. It just sits there. It doesn't generate interest, it doesn't pay a dividend. In a high interest rate world, holding gold is expensive, not in fees, but in the interest you're giving up by not owning something like a government bond, which pays you a steady return. That lost return is the opportunity cost. But when the Fed signals it's going to cut rates, the yield on those government bonds goes down. Suddenly, the interest you're giving up to hold gold is much smaller, the opportunity cost shrinks, and gold becomes a much more attractive asset to have in a portfolio. It's a classic inverse relationship. As the expectation of lower rates goes up, the attractiveness of gold goes up with it. But that's only half of the monetary story. The other half is the US dollar. When markets expect the Fed to cut rates, the dollar tends to weaken against other global currencies. And because gold is priced in dollars all around the world, a weaker dollar acts like a discount for anyone buying gold with euros, yen, or any other currency. Imagine you're in Europe and want to buy a 1-ounce gold coin. If the dollar weakens against the euro, that same dollar-priced coin now costs you fewer euros. It's effectively on sale. This boosts foreign demand for gold, pushing the price even higher. So, the Fed's expected pivot creates this powerful 1-2 punch. It makes gold more attractive to hold and cheaper to buy for a huge portion of the world. This is the immediate mechanical reason why the gold price today is soaring. It's the obvious catalyst. Okay, so we've just connected the dots between US economic data, the Fed, and the price of gold. If you're starting to see how these powerful forces connect, do me a favor and hit that like button right now. It's a simple click, but it sends a huge signal to the YouTube algorithm that this is valuable information, and it helps the channel reach more people who are trying to make sense of the markets. Thank you for that. If the Federal Reserve's policy is the spark, then global uncertainty is the fuel being poured on the fire. Gold has a history that stretches back millennia as a safe haven asset. It's what investors and even nations turn to when they are worried about the future. It's financial insurance against chaos. And right now, there's no shortage of chaos. First, there's a high degree of political and economic uncertainty within the United States itself. Debates around trade policy and the imposition of new tariffs create unpredictability for businesses and investors. When the rules of global trade are in flux, it creates risk, and markets hate risk. We've also seen political moves that have raised concerns about the long-term independence of the Federal Reserve, which is the bedrock of the U.S. financial system's credibility. Any perceived threat to that independence makes investors nervous. Zooming out, the geopolitical landscape is tense. The ongoing conflict in Ukraine continues to have ripple effects on energy and food prices. Tensions in the Middle East remain a constant source of potential instability. These aren't just abstract risks. They have the potential to disrupt supply chains, cause energy shocks, and slow down the global economy. In this kind of environment, gold shines. It isn't tied to any single country's political decisions. It can't be devalued by a central bank printing more of it, and it has no credit risk. It is a tangible asset that exists outside the traditional financial system. When investors see storm clouds gathering on the horizon, whether they are political, economic, or military, they instinctively reach for the financial umbrella that has weathered every storm in history: gold. This flight to safety is adding massive demand pressure, pushing the gold price far beyond where monetary policy alone would take it. We've covered the Fed and we've covered global fear. Both are powerful drivers, but neither one is the biggest part of this story. The most significant, most structural, and most underreported reason for gold's historic rally is happening in the vaults of the world's central banks. This is the hidden earthquake. For the first time since 1996, let that sink in, for the first time in nearly 3 decades, the world's central banks as a group now own more gold than they own U.S. Treasury bonds. This is not a small adjustment. This is a monumental shift in global financial strategy. Analysts are calling it one of the most significant global rebalancings we've seen in modern history. For decades, the default reserve asset for any country was the U.S. Treasury bond. It was considered the safest, most liquid asset on the planet. Backed by the full faith and credit of the United States government, nations held trillions of dollars in U.S. debt to stabilize their own currencies and manage their economies. But that is changing. A diverse group of countries, from China and India to Poland and Turkey, are now systematically selling their U.S. bonds and using the proceeds to buy physical gold bars, which they are storing in their own vaults. Why are they doing this? The reasons are a mirror image of the fears driving individual investors. They are concerned about the long-term sustainability of U.S. debt. They are worried about the impact of U.S. trade policy and the potential for financial sanctions. They are looking to diversify their holdings and reduce their dependence on a single currency, the U.S. dollar. This is what makes this gold rally different from others in the past. It's not just being driven by temporary market sentiment. It's being driven by long-term strategic policy decisions made by nation-states. This institutional buying creates a massive and consistent source of demand for gold, putting a very high floor under its price. What we are witnessing is a quiet, deliberate move away from a dollar-centric world and toward a multipolar financial system where gold is being re-established as a core neutral monetary asset. The soaring gold price is the most visible symptom of this deep structural shift. This strategic pivot by central banks is the biggest part of the gold price story that almost nobody is talking about on the mainstream news. It has massive implications. So I want to hear from you. What do you think this move toward de-dollarization means for the future of the global economy? Drop your thoughts in the comments below. I'm genuinely curious to see what you think, and I make it a point to read every single one. Let's start a conversation. So, what are the consequences of this perfect storm? The effects are already being felt across the board. For the global financial system, it raises long-term questions about the future of the US dollar as the world's undisputed reserve currency. For corporations, it's a mixed bag. Gold mining companies are seeing record profits, but industries that use gold, like jewelry and high-end electronics, are facing a massive increase in their costs. You may have noticed that jewelry demand is actually down this year. That's because the high price of gold is making it too expensive for many consumers. And that brings us to the impact on individuals. First, the weakening dollar that is helping to push gold higher also makes all the goods we import from other countries more expensive. That contributes to inflation and eats into your purchasing power. Second, It directly raises the price of consumer goods that contain gold, from wedding rings to the components inside your smartphone. Finally, it forces a reevaluation of what safety means in a portfolio. For those who hold gold, this rally has been a significant source of returns. For those holding cash, it serves as a stark reminder of how the value of paper money can change over time. It's a complex picture with both winners and losers. So there you have it. The record-high gold price of 2025 isn't a simple story. It's a perfect storm created by three massive forces all hitting at once. A dovish pivot from the Federal Reserve, a global flight to safety amid rising uncertainty, and most importantly, a historic and strategic pivot by the world's central banks away from the US dollar and back towards gold. It's not just about the Fed, it's about a fundamental rebalancing of the global financial order. Now, you have a clearer picture of the forces shaping our financial world. But the conversation doesn't end here. I want to know what you think. Leave a comment below with your biggest question or your single biggest takeaway from this analysis. And if you're ready to tackle the next big topic in finance, click on the video right here. To make sure you never miss an insight and to join this community of smart, curious people, hit that subscribe button. Thank you for spending your time with me today. I'll see you in the comments.